Okay. So we're going to start 1 minute early, just so we have extra time for Q&A. So I'm Laura Schwammen. I'm a PhD candidate in city and regional planning. So thank you all for coming here. I know it's Halloween and people have other exciting things to be doing. So for this talk, Rachel's going to speak, and then we have 2 respondents, and then we'll have time for Q&A at the end. So if you have questions, just wait. You will get a chance to contribute to the discussion. So Dr. Rachel Weber is a professor in urban planning and policy at the Department of, at the University of Illinois in Chicago. She's taught and conducted research in the fields of economic development, real estate, city politics, and public finance. Her book, From Boom to Bubble, How Finance Built the New Chicago, won the Best Book Award from the Urban Affairs Association in 2017. And her current research project, tentatively entitled The Urban Oracular Prediction and Speculation in Real Estate, unpacks the mechanics of contemporary property speculation in an age of financialization and digitalization. So we're really happy to have you here today to present on your work. So please welcome Rachel Weber.
Thank you, Laura. You can all hear me? It's okay, I don't have to scream? Awesome. So yes, thank you, Laura and Flavia and Sai and Julian and Amanda, everybody at BESI and DCRP for inviting me here and making it possible for me to address you today. I'm thrilled to present this new work from my new book project, and I'm sure I'll get a lot of very constructive and helpful feedback from you all in the discussant period and the Q&A. So my presentation is from this book that I'm writing. I don't know what the title should be. Maybe I should have like a competition to name it. But it is, as Laura said, about property speculation, which I felt was sort of, it was time to kind of reappraise this concept. But property speculation in an era of financialization and digitalization, and I'll explain what that means. And it is based on several years of ethnographic research, interviews that I've been doing with quants, which are the analysts who work in the commercial real estate industry, textual analysis of the artifacts that represent current and future property markets, spreadsheets and models, consulting reports, investor presentations, and also participant observation at events like the Urban Land Institute's Market Outlook conferences, of which sometimes I have also participated on panels like The Future of the City. So I guess you could say it's also based on a kind of autoethnography or data from that kind of data gathering exercise. So, and I ground this research in a diverse set of literatures from the sociology of algorithmic and quantitative knowledge to more sort of classic urban political economy, with the goal of reconciling a more constructivist approach that you find in science and technology studies and sociology with a more sort of materialist approach that you would find in political economy. And you can tell me if you think that is possible or if I should, you know, surrender Dorothy. So just kind of just give up while I'm ahead. And speaking of witches, again, it's Halloween. So I thank you for being here, especially those of you with children who are trick-or-treating, or if you have to hand out candy. As I was thinking about my talk, I was also thinking about, you know, how can I connect my book to the theme of my favorite pagan holiday, you know, of Halloween? And I've made some kind of tenuous connections. The first is that, you know, it's just sort of like what's at stake. I think we are witnessing some unsettling and maybe bone-chilling dysfunction in property markets these days, dysfunction that has been weaponized in the NIMBY versus YIMBY debates. The so-called laws of supply and demand don't seem to apply when you see record asset inflation during a global pandemic, or rapid housing value appreciation in the same markets as those with vacancies, pretty, you know, significant vacancies, or the public sector's tax hauls decreasing despite property owners recording massive windfalls, or getting to some debates this week, or mortgage rates increasing even as the federal funds rate is going down. So neoclassical economists and Marxist critics rarely agree on anything, but both seem to agree that property speculation is often often to blame for these quote unquote, sort of dysfunctional or inexplicable dynamics. It's kind of the X factor that you'd point to when everything sort of seems out of balance. But it's also very hard to measure, and I'm happy to sort of talk about that in the Q&A. So what is property speculation? It's not just a pejorative term for any kind of real estate investment. Speculators purchase real property assets with the intent of selling them in the near future. They commit capital to real estate in anticipation that its price will benefit from future uncertainty. And there are two key elements of property speculation to keep in mind. The first is what I call the spread. Property speculators pursue the differential between what they paid for an asset and what they can sell it for. And when it's positive, that spread is called a capital gain, which is realized at the point of sale, but as I'll explain, is actually anticipated far in advance. And it can actually, unrealized capital gains can also be sort of a very useful sort of asset in property speculation. Most speculators are highly leveraged, so they've taken out a lot of debt on the properties they own, and they can just barely cover their debt service payments with cash flows from the rental income that they receive. Therefore, they're really banking on that holy grail, right? That differential or the spread. They want it to be large enough to emerge with a profit after the holding period. And that's the second element, the gap, the holding period. The fate of property speculators depends on their ability to acquire and subsequently unload their properties during what they know are finite windows of opportunity. Real estate speculators generally anticipate 3 to 5 year hold periods before they cash out and move their capital elsewhere. The direction of the spread, whether it's positive or negative, is often less important than its size. Although speculators risk the possibility of taking a haircut or losing equity if their property's value falls below the debt that is underwritten on it, depreciation can also be treated as a lucrative tax loss, particularly when considered along with the positions that speculators have taken on other assets in their portfolios. Property speculators are professionals, they're corporations. I'm not talking about the individual homeowners who are hoping that their property values increase so they can pay for their kids' college tuition. But these are firms that place their own capital and that of their clients, mostly institutional investors like pension funds and sovereign wealth funds, in complex tiered networks of extraction anchored by portfolios of properties and the debt on them. They engage primarily in 4 operations. They acquire, or rather they aggregate dispersed sources of capital. They acquire commercial real estate, and I'm really focusing here on income generating properties like office buildings, malls, apartments, through ownership vehicles like funds and trusts and syndications. They appropriate the spreads through an apparatus of capture, like a limited liability corporation, and they distribute the spoils based on different sharing rules articulated in contracts, accounting principles, and tax laws. The largest owners of property and contributors of equity to real estate are companies that are generally not listed on the stock market. And these include firms like Blackstone, technically a private equity fund, who at $1 trillion has the largest assets under management, or AUM, in the world. Property speculators also include publicly listed REITs or real estate investment trusts like the Simon Group, they own malls, investment banks like JP Morgan Chase, and legacy real estate companies like JLL and CBRE that also have investment arms to kind of round out their brokerages. And they earn profits from these capital gains in addition to the rents they collect from leasing assets to tenants and fees from managing other institutions' monies. So the investment committees at places like Blackstone and JLL want to know which properties they should acquire or extract from their portfolios. They want to know whether, for example, they should place their clients' capital in San Francisco or Seattle. And if the answer is San Francisco, if they would be better off buying an existing apartment building or constructing a new suburban office campus there. But how do speculators know what's going to happen to the value of the apartment building in San Francisco that they're considering buying, 5 years in the future? They don't. the future lacks an ontological status that can be predicted with any certainty. But speculators' lack of cognitive access to the future does not stop them from trying to account for and anticipate the forthcoming. And this is where a second tenuous connection to Halloween comes in, the supernatural, right? Like witches or the oracle at Delphi, speculators are also prone to prophecy and prognostication. They cannot place their bets without also having imagined the uncertain future. In fact, property speculators engage in forecasting with vim and vigor. So in the book, I'm documenting what I call the predictive knowledge practices that are part of each of those 4 speculative operations that I just mentioned. So who forecasts? The contemporary property forecasting industry is extensive and multi-sided. Future knowledge is produced in-house at the largest property speculators. So I interviewed a lot of the quants who are at research desks, in larger, in larger real estate companies or in investment banks. You may have your own real estate desk. And that's where you see a lot of the kind of forecasting activity taking place. But speculators can also contract out to third-party consultants, many of which were started by academics, some of them from this university, and who market their superior analytic and interpretive skills. For example, one of the largest forecasting operations is Moody's Analytics, spun off from the bond rating agency that shares its name in 2007, it spun off by acquiring several software firms that assessed household credit risk. So there's not such a jump between analyzing credit risk and being able to to forecast the future. So Moody's sells products like climate risk scores and during the pandemic, COVID-19 economic forecast scenario software. Property speculators also get their knowledge about the future by subscribing to different kinds of data brokers or data services. And these include those provided by first wave data brokers like CoStar, that was incorporated pre-internet in the 1980s and developed some of the earliest data platforms. Essentially what they started doing was privatizing publicly available information like tax assessments and deeds of sale. Then there was what I call a second wave of data companies that got their start in the 2000s, selling information covertly captured from either their own online marketplaces like Zillow or from proprietary operating systems. And an example of that is Castle Systems. If anybody's doing research on return to work or urban downtowns, you've probably encountered Castle Systems data. They use their patented office security systems to track building access from fobs, mobile devices, and video surveillance. So every time you walk in or out of an office building, they know that you've done that. And then they turn around and they sell that information to property managers interested in benchmarking return to work trends against their peers. These prop tech firms join a third wave of startups that uses data mining techniques, pattern recognition software, application programming interfaces to engage in what's called predictive analytics. These are firms that provide forecast. These firms pretend or attempt to use their data skills and their analytic skills to predict the future. And these different kinds of firms kind of blend together. I mean, the categories are porous. For example, CoStar has been partnering with consultant Oxford Economics to offer forecasts and interpretations of CoStar's own data. But what is clear is that in the last decade and a half, we've witnessed a proliferation of these kinds of forecasting firms or prop tech firms, data platforms, and computationally generated predictions catering to the real estate industry's unquenchable thirst for information about the future. I analyzed data from PitchBook and found that the firms providing these kinds of predictive knowledge services to property speculators in 2020 was about 8,000 strong, about 8,000 firms, and that's a 300% increase from 2010. So to give you a better sense of these kinds of firms and what they do, I want to show you a quick video, if I can make it work, from one of the companies that I've been tracking, and that's a firm called Skyline AI. And they're now owned by JLL, what used to be Jones Lang LaSalle, who had initially fronted the venture capital for this particular firm. And so let's see if I can get there. Yes, I hope this will work.
In recent years, financial markets have been transformed by advanced technologies.
Well,
Yet the largest market of all, commercial real estate,
it's very short,
remained virtually unchanged. A few exceptional investment managers rose above the rest, but even the most capable remained confined by the boundaries of human ability. Skyline AI fuses the expertise of select commercial real estate partners with artificial intelligence to achieve above-human performance. Continuously processing millions of diversely sourced data points, Skyline AI covers over 400,000 assets, observing every deal made in the last 5 decades. Using a proprietary ensemble of machine learning models, Skyline AI decodes the mechanics that govern the market. We identify emerging trends from the cross-continent to the neighborhood level, pinpointing the areas that are about to take off while avoiding potential downturns. Through deep analysis of owner and asset behavior, we detect value creation opportunities, off-market deals, distress signals, mismanagement, and various performance anomalies. Uncovering hidden risk factors, we vet opportunities that can withstand uncertain market conditions. Underwriting within seconds, we are the first to secure high-value deals. Injecting advanced technology into the commercial real estate market, we take investment management beyond human boundaries. Skyline AI. Real estate investment meets artificial intelligence.
How do I make this? So Skyline AI promises to predict when a property will go on the market, what the rent will be in each unit, and which properties will outperform others. That's what they say on their website. Other forecasters similarly claim to be able to detect pricing anomalies and opportunities for extracting value from the city before they brag owners of properties themselves are aware of those options. The future may lack an ontological status, but as the philosopher Giorgio Agamben notes, potentiality creates its own ontology. And I've been fascinated with that idea. Potentiality creates its own ontology. The ontology of the urban future articulated by property forecasters like Skyline AI is not one of climate or political dystopia, which is where my brain goes. Instead, it's just the opposite. The crowded field of real estate futures augurs endlessly increasing growth and envisions the future as a free resource base to appropriate, if you know which rocks to look under. So Skyline AI offers vast reserves of property data unimaginable in their totality, as well as they say, beyond human algorithms to quantify potentiality. Speculative opportunities become tangible economic objects in the digital worlds that they construct. So how do forecasters know how the future will look in the absence of crystal balls or tarot cards or tea leaves? Again, they don't. But that doesn't keep them from performing a variety of arithmetic and statistical calculations and analyses. They conduct buy, sell, hold pro forma analyses in which they apply forecasted rates of change in rents, for example, to individual assets to estimate values, yields, and total returns. Their analyses are also used to calculate the value of entire portfolio. In portfolios, cordoning off or parsing together expected income streams. This kind of information, the output from forecasting models, is often referred to as forward-looking information, which is a legal term developed by the SEC, the Securities and Exchange Commission, to sort of categorize these sort of estimates of the future, to also show that you're not that the originators of that forward-looking information are not liable in the event that their forecasts don't pan out. It's a little bit like, you know, the things that you see on ads for pharmaceuticals on television, or like, you know, the language that you find on boxes of cigarettes. So some of the models that I discussed with the quants that I interviewed were probabilistic, like Monte Carlo simulations, or dynamic, like Markov chains. But most of the forecasting techniques that the property speculators that I was interviewing used were kind of basic, spreadsheet-based ones, discounted cash flows, and hedonic regressions that involve subjectively human judgments about model assumptions and not necessarily algorithmic calculation. The assumptions that go into their models are often like things like how fast rents will likely grow or what exit cap rates should be, so that they'll know how much buildings will be worth when they plan to sell them. But what is new and more automated is the data that is fed into these models. So data has definitely become more granular, more frequent, and more voluminous. And this fulsomeness is partly due to the data scraping codes and monitors that endow every function of a building now with calculation. Like castle systems that I mentioned, your comings and goings, into an office building, how many times you took a smoke break, all of this can be surveilled and quantified. Add an interface layer on top of these data-fed models, and you've got yourself a platform. Like a modern-day Oracle of Delphi, you can now plug in some parameters into empty cells on your computer screen, and the platform will spit out what it estimates 100 self-storage units on the outskirts of Oakland will likely be worth in 5 years. So scholars like Julian and Desiree and others have done some excellent work on datafication of buildings, showing how that helps to create new asset categories like the single family rental, and how these forms of datafication enable the predatory management of rental properties. And I'm mining a similar but adjacent vein, looking at how these digital prosthetics help property speculators claim and capture spatial futures. So my book explores how forecasting enables speculation by following some forecasted output up the food chain within individual asset managers and investment banks, and then how other forecasts get circulated external to the firms that originate them, and across these sort of stratified professional networks. So this latter category includes much hyped predictions, such as ones about how by 2030, 30% of all office space would be used by short-term flex space providers like WeWork, or the prediction that there would be a need for millions of additional warehouses because of the insatiable desires of third-party logistics providers, or how there would be a V-shaped recovery after the pandemic. And some of these predictions came true, but I'm not necessarily assessing the accuracy of forecasts, and trying to determine if relying on them helped Blackstone achieve higher absolute returns or outperform their competition. In fact, there's a little cottage industry of doing this kind of retrospective analysis to see how well people forecast. I mean, Nate Silver, who we all know now as we're watching the election or predicting the election, is kind of like the king in that realm. But what I am interested in is what this fortune-telling mania and recent changes in the real estate speculation and forecasting industry portend collectively. I argue that forecasts enable speculation not because they necessarily accurately predict the future, but because they help speculators to convert imagined spreads into capital in the present. And they do this by producing conditions of comparison. So forecasts render imagined property markets tractable and visible. And they set up comparisons between the now and later that can be included in other models and reports and ultimately acted on. They transform representations of the future into usable facts and hold space for these potential differentials. One of their main uses, or one of the main uses of this forecasted output, is to help speculators access capital. For example, banks release credit when forecasters quantify the appreciation of properties pledged as collateral. The expected spread is converted into loan proceeds in the present and pumped into the asset, therefore inflating futures in a kind of self-fulfilling prophecy. When coming from credible sources and or circulated widely, forecasts can shepherd the crowd in the same direction. So real estate is a very tightly knit industry where everyone is sort of observing each other, looking over their shoulders to see what their peers are doing. And that's partly because, not just because they're paranoid, but because they know that in some ways you can't speculate alone. If you make a bet, you need others to sort of follow suit in order for prices to rise. So expectations about the future are capitalized into present day pricing. Property values go up and down less because of what individual owners do with their holdings than because of the iterative feedback of actors operating in the same market, acting on comparable hunches at roughly the same time. Forecasts provide a reference point that can coordinate the behavior of this crowd. Because promissory abstractions like property forecasts can produce their own realities, speculators seek to influence the means of prediction. They use different methods to put their imprimatur on future imaginaries, and I just want to discuss two very briefly. So first, speculators engage in what communications scholars call information activism, to reach other market participants and solidify their reputational value. They hire PR teams to attest to their forecasting acumen and circulate persuasive future imaginaries. Some of the larger forecasters make public pronouncements about future trends, sharing their canned predictions for free through glossy outlooks, websites, and podcasts. They also try to influence the context for where they encounter their peers. So things like the Urban Land Institute that hosts panels or has publications with titles like "Where is the market headed?" or "Experts predict where the office market will be in the next year." As I mentioned, I conducted participant observation at some of these meetings and sort of came to appreciate the important role that these intermediaries like the Urban Land Institute play. The most powerful speakers at these events tended to mix bravado with optimism. They used powerful language and verb tenses that describe rather than overtly predict the forthcoming. So interest rates will widen out because of a new risk premium, or residential markets will tighten. Preferred experts are more often those with skin in the same future imaginaries that they are selling, representatives of legacy real estate companies and investment funds. So it was common to hear from a representative of a company, say with significant holdings of apartment buildings in Nashville, that the future of multifamily housing in Nashville looked exceptionally bright. Intermediaries like ULI also play an important oracular role. They conduct sentiment surveys of their members and assess the retrospective accuracy of forecasts made by others, even providing awards to those firms that make the most correct calls. While influence over predictive knowledge infrastructures can be reputational, it's kind of soft power, it can also be exercised through brute force, which is what we've seen since the global financial crisis of 2008. So after that time, the largest asset managers, data brokers, and real estate companies went on a mergers and acquisitions spree, picking up both small prop tech startups and each other. An oligopolistic market structure of cartels now controls the primary data sources and interfaces through which the real estate industry views the future. Some of the mergers and acquisition activity was from companies offering the same services. These are what are called horizontal mergers. For example, publicly traded data broker CoStar spent over $2 billion acquiring 17 prop tech and digitized platforms during this period. But on a dollar for dollar basis, the bulk of acquisitions in this industry since the crisis has been what we call vertical mergers and acquisitions. So between two companies that provide different sort of pieces or functions of the supply chain. So JLL is one of the largest real estate companies, they're called legacy real estate companies in terms of the assets under management that they have. And it's been one of the most aggressive buyers of prop tech firms, acquiring over 108 between 2008 and 2023. In 2018, it launched its own $100 million venture capital fund called JLL Spark to make early stage minority investments in real estate startups. And Skyline AI, the video I showed you without audio, was one of the approximately 32 valuation, data, and analytics firms that it acquired during that period. So there are a lot of different reasons why this mergers and acquisition activity has occurred. Revenue streams from data platforms are considered to be more stable and predictable than those from direct ownership of real estate. So once a database is complete, for example, it can be automatically updated with data scraping tools and algorithms and AI. Once a platform is engineered, the cost to serve each new subscriber is effectively zero. But at a corporate level, my interviewees, when I asked about this activity, they said that they saw data, and they didn't use this language, as data about property as a potential fix for the accumulation crisis that felled the industry in 2008. So in the words of one of my interview subjects, getting into property data made sense because it was cheap, monetizable, and maybe it will be useful to somebody someday. So kind of blasé attitude, right? So nobody's admitting that speculators are buying, predictive analytics firms because they want to dominate the future, right? But in some ways, I'm beginning to move in that direction in terms of my own interpretation, even though honestly, at this stage in the game, it's a little hard to gauge the impact of what this market concentration really means. But, of course, I'll venture some speculations. Vertical integration will likely allow speculators who own data companies and these predictive analytics firms, PropTech firms, to raise the prices that they charge their clients for the products and services they offer. So for their investment acumen, their consulting services, their brokerage services. While we may not be so worried that JLL can charge pension funds more, as the owner of $90 billion in assets under management, $90 billion in property, as well as the technologies that others use to interpret property markets, JLL has the power to coordinate the behavior of much larger markets, right? They could potentially send out bat signals for developers to hold back supply, or which would inflate pricing in places where JLL owns a significant market share. The potential for collusion has become more real as we see a spate of lawsuits against real estate data firms alleging that their products enabled property speculators, landlords, and operators to engage in price fixing. The Hausers in the audience are probably familiar with the YieldStar case. This is a case where the Department of Justice is investigating YieldStar, which is owned by data broker RealPage, as part of an antitrust lawsuit filed by dozens of tenants accusing the platform of enabling landlords to raise rents by showing them inflated comps and opportunities for value extraction. This year, too, there were a bunch of other lawsuits, one against CoStar. They had a class action suit filed against them, claiming that the data that they provided to several hotel operators, including Marriott and Hilton, allowed these hotels to artificially boost the prices that they charge for their rooms. So meanwhile, the veracity of counterclaims on the future from those without capital and whose visions of the city do not align with forecasters' inflationary imaginaries, these are challenged. Sociologist Barbara Adams noted that every act of future making is also an act of future taking. So when tenants go on strike for no or slower rent increases, or when states attempt to claw back a portion of speculative gains by raising property taxes or instituting transaction taxes, they're told that they're out of luck. Future revenues and these differentials have already been claimed and committed. Capital has gotten there first. So in conclusion, I argue that the extraction of surplus value from landed property comes not just from monopoly ownership of location, but also from the ability to influence expectations about the future. In the self-referential world of real estate speculation, where value is based as much on the anticipation of appreciation than on current cash flows, forecasts strategically enable speculators to conjure the rent gap and capture intertemporal value differentials before they even exist. Like meteorologists, real estate forecasters predict the future. Although it is possible to change the weather to achieve the desired outcome, so I hear that you can disperse chemicals into clouds, which could produce precipitation. I don't know, maybe you've tried that here in San Francisco or in the East Bay, which is very dry. These occurrences are pretty rare, right? In contrast, owning both the means of prediction and the means of production is much more common, as we have seen in the last 15 years. Restructuring in this industry is empowering a handful of firms specialized in reading the future to also modify it to their advantage, not with chemicals, but with control over data, insight, and capital. Or as the anthropologist Urena Searle elegantly put it, the fragile cascade of assumptions about time and money makes the present unfold in accordance with representations of the future made in the past. Real estate speculators have acquired this ontological privilege both through their communicative acts as well as this anti-competitive behavior. And it has allowed them to perform versions of the future that bend the production of future values around their own positions. And I think that's kind of scary. So thank you very much.
Thank you, Rachel, for this super presentation. I personally could not help but think of the few months that I worked for Credit Suisse, the investment bank, and I was an intern there at macroeconomic research, and I would run models to estimate GDP, and my boss would then change a coefficient, so the GDP would lead to the result that he imagined. So I think this is, yeah, I think very appropriate. Okay, so I think we can turn now to the questions and notes of Sai and Julian, and then we turn to questions from the audience. I'm just going to introduce Julian and Sai. So Julian Migosi is an economic and urban geographer. He is currently an Urban Studies Foundation postdoctoral research fellow at the University of Oxford and a visiting scholar at the Department of Sociology and the Berkeley Economic and Society Initiative at UC Berkeley. His work lies at the intersection of financial geography, urban studies, and economic sociology. He did research. His research examines how digital capitalism reshapes cities and markets, questioning theoretical boundaries and empirical connections between the global north and the global south. Sai Balakrishnan is an associate professor of city and regional planning at UC Berkeley. She's also co-director of Global Metropolitan Studies and the chair of the Urban Studies undergraduate major. Her research and teaching broadly pivot around global and urban inequalities with a particular focus on urbanization and planning institutions in the global south and on the spatial politics of land use and property. I think you choose who can start.
Okay, so I'm the first one to go apparently. So hi everyone, it's a pleasure to be here and it's an honor to get to discuss Rachel's work. Can everyone hear me? Yeah, really cool. So I read Rachel's paper last night and I got super excited because I think it's a agenda setting research proposal for three reasons. The first one is that I think for people like me who've been really studying financialization, housing, real estate over the last decade, it is a paper that talks about forecasting the future. And by doing so, I think it's also forward-looking in a way that most of the field of real estate studies have been really, I would say, haunted by the global financial crisis of 2007, 2008. It's very hard to find a paper that does not mention that as a reference point, as a triggering point for the type of real estate markets that we see today. And you do mention the global financial crisis, but you don't present that as a pivotal moment. Although I think you do acknowledge that, but by encouraging us to see how real estate is produced and calculated in the future, I think we kind of sort of like put that ghost of the global financial crisis in its space and maybe move forward towards market cycles or maybe shrink this very important case study within a longer lineage of evolution of real estate. So I think that that's very precious. It's like bringing a fresh breeze to the field. By bringing real estate, not necessarily where it is built, financed, but more where it is measured, narrated, datafied for speculative purposes. The second reason why I think it is quite an agenda-setting proposal is because it recontextualizes prop tech as an industry within the larger stratified, you call that stratified professional networks of real estate. And I think we've been looking for an intervention that would actually put prop tech in its place, propose to identify some sort of institutional boundaries of that specific industry. Because it became such a large umbrella term, putting together property and technology, sometimes we would designate everything and everything as prop tech. And I think we were losing some sort of analytical power here by overstretching this term. The fact that you reinscribe prop tech within the larger industry of well-identified actors that have been here for decades is quite helpful, maybe to disrupt the buzz, but also to understand that prop tech is just maybe a small component on the wave of consolidation of where real estate markets are going. So that would be my second point, like put prop tech maybe in its place by identifying boundaries. Third, and I think this is, given my own personal research interest, this is like something that I find extremely exciting, is that I think we, as scholars, really understood how finance intersected with real estate. Recently, there's been a wealth of studies about that. But what you propose to do here, I think, is to really bring real estate studies into the realm of informational capitalism and the attention economy. And I think this is something that we need as well, because as real estate enters the field of digital capitalism, it creates new avenues of value creation. For instance, through subscription-based software, access to property data. It's like the real estate economy, the creation of value was mostly, how can I say, indexed on contract, sales, rents. Now you can create this new revenue flow through data stream just because the information has been digitized. So it's like real estate as a mechanism of value creation is shifting because it's entering new cycles of value creation through the importance of data and digital. If we understand how informational capitalism within this room, that the design of information system within specific business model creates political and economic power, then you really show what this transition to technology, how it affects real estate as a field. Where, as you describe, I think there is, just like in the tech world, there is a winner-takes-it-all approach, a tendency. If you move in first, if you collect the data, if you consolidate different companies, if you acquire, if you extend your network, then you can reach some sort of monopoly, oligopoly effect. And I think in that regard, real estate has a lot to learn from studies on platform capitalism. And I think you contribute to that, saying that, you know what, now real estate is also about the attention economy, bringing data to eyeballs and people, because that's what authority and legitimacy are for market players. I have 5 questions, maybe. Given that, I'll try to make it first. So the first one, I guess, is about the role of calculus and the appetite for data and the role of technology in real estate today. When I see your presentation, I cannot help but think that real estate losing some sort of industrial identity. I attended, for weird reasons, the global startup competition in San Francisco a couple of weeks ago. And we had the same type of panel where people were predicting the future. You know, we think like startup valuation, the price has come down, people need to be, you know, fall in line with expectations. And they were doing this same work of shaping where the industry is going through some sort of legitimacy based on the collection of data. So I guess my question here is this quest of information, this information on steroids, is it another attempt of the real estate industry? We have always been obsessed about data, it's always been an information sensitive industry. So is it another attempt in getting the price right? Or is real estate becoming obsessed with data because now, to do business, all legitimate corporations need to display or adopt data-intensive positions? It's a bit of a chicken and egg question, but is real estate an industry of information once again? Or is informational capitalism coming to real estate and changing it? So that would be my first question. The second, I'm wondering this corporate networks that you've been presenting that predict the future, how does it map out to the construction sector and the planning sector in the US? Which I think from what I read is still characterized by the importance of small size operators, small size constructors, which are more city oriented. So how does this large scale prediction of the future, how does that interplay with the nitty gritty aspect of real estate work and construction? Where that's something I'm wondering and about which I'm completely ignorant. The third question is, since you've been talking to on these quant guys, but also since you've been underlining how prophecy, vision plays a key role also through the personality of people, what's left for visions and gut feeling in this industry, which has been like very important in terms of value creation. I know finance, as much as finance became really data driven, it's still about feelings, trust, rumors, confidence, expectations. So does this embrace for data and prediction? When you talk to people, is there still some sort of, no, I know, like it's not in the data, but I know that this is the place we need to be, this is the place to invest. Fourth, maybe what's left for the ordinary residents in this speculative future? Are we just trapped in the story that they design? I think everyone here has been using Zillow, I guess, at some stage, but we are also encouraged to take future-oriented market actions. And I'm wondering how this future-oriented home seeker interact as a predicted consumer with the future-oriented institutional investor. And fifth, this is a big question.
Like your other four were not.
Sorry, no, sorry. But if you, what you're saying is that speculation is actually encoded in the data for creating the spread. So imaginations of the future are actually reflected in these spreadsheets or the numbers. And as real estate become more digitized, I'm sure that just like many of you in this room, sometimes we see this wealth of data as some sort of untapped research opportunities. If only I have access to all GLL database, I could do some incredible research. But if that data is already speculative, then how can we as scholars develop a form of knowledge that would not be speculative if we use the same data source and if we consider them as some sort of research, I don't know, data goldmine? I'll stop here. Thank you very much.
Good questions. Thank you.
Thank you so much, Rachel. I'm having a bit of a fangirl moment because you know how much I love your research. And particularly to the planners in the room, I think there's something remarkable about your research because on the one hand, you are a critical theorist, right? You think about power, who wins, who loses. And at the same time, financialization, land financialization is a beast, right? And I say this with deep regret. I think very few planners actually get it. And you're one of the few planners who does, right? Evidenced by you having served on various committees, including with former President Obama. And since we're talking about the expertise of forecasting in your talk, I just wanted to say what a huge admirer I am, really for your expertise of doing critical research with policy implications, right? Because bringing critical theory and policy together, it's just a remarkably rare feat. So with that, I have a few questions, 3 questions. Feel free to answer some of them, none of them, but I just wanted to offer them and lay them on the table. The first is I think it's a very, very clever title. It's very catchy, Seizing the Means of Prediction. It also puts you in a very specific ideological, you read it in a very specific ideological way. It's a very clever riff, of course, on seizing the means of production. And I was wondering how we can think about your intellectual lineages and how you're approaching these really complex questions around land financialization, right? Because on the one hand, you do come from urban political economy, but I don't see you as a Marxist scholar. And yet, when I was listening to your presentation and also having read your works, there seems to be this very strong engagement with performativity of economics, right? Like this really important strand of STS scholarship that talks about how economic models are not just predicting societies, but those very economic models are organizing societies, right? So I was just curious about your intellectual lineages, not to box you within any categories, but particularly for us planners in the room, right, to understand how you're doing this kind of boundary crossing research, right? The second question that I had was on knowledge brokers. And this in the paper that you circulated to Julian and me, you talk about intermediaries, right? Which is a very apt and precise way of thinking about financialization. And you write about this crowded field of knowledge brokers and intermediaries, many of whom are operating independently with actors in each sector ignoring the other. And I just found this so fascinating because what you're pointing to is the immense work that goes into predicting and securing the future, right? So you can't talk then about some capitalist system or logic, but you're really showing us the range of capitalist practices that make possible this conjuring of future value, right? So here I just wanted to put your work in conversation with another scholar whom I deeply admire, and that's Lorena Searle, Landscapes of Accumulation. And Lorena writes about the stories, the fictions, the practices, the social relations that go into predicting land value in India. And then she makes this very, very interesting argument where she says, on the one hand, land financialization relies on intermediaries, but those intermediaries themselves become the sources of risk for financialization, right? So in other words, there's a contradiction of intermediaries here, a capitalist contradiction of intermediaries. And I was wondering, through your ethnographic research, I would be curious about conflicts. Like, were there conflicts that arose, not so much the antitrust cases, right? But were there conflicts that arose where land values are not commensurate across these models, right? Where this kind of alignment of cheap talk, so to speak, doesn't happen. Because then those conflicts reveal the contradictions in intermediation, right? And the third question that I had was, you of course talk about prop tech firms, and in the article, you also break down this category, arguing why it's not very helpful. But I would be curious on how to historicize prop tech firms, right? And I asked this question inspired by your own previous research. So again, masters, planners, you talk about tax increment financing, which is this municipal debt instrument. We all assume it explodes post-financialization, post-1980s. And you have this wonderful piece where on the historical roots of tax increment financing, where you actually remind us that the historical roots are in an earlier era of federal assistance to municipalities, right? It was urban renewal consultants who are then the knowledge brokers of tax increment financing. So very much in the same spirit, I'm wondering, how do we historicize prop tech firms and financialization? I was delighted when you mentioned Urban Land Institute in your paper, because in the professional schools that we teach in, ULI is normalized, right? We use the language of ULI. Our students are taking part in ULI conversations. And yet ULI is an extremely old institution, a professional membership association. There's a wonderful book by a historian called Sarah Stevens that I'm now reading on
expertise
developing expertise, right, and the history of ULI. And so how do you historicize PropTech, just given these much older planning institutions, which are now at the bleeding edge of conjuring the future? Right?
Okay, well, I don't want to keep everybody past 5, but I'll try very briefly to respond to your comments, and then we'll open up. Does that make sense? And some of them I'll just say, that's a great question, and we'll talk about it sometime later. But thank you so much for the deep engagement with my work and the kind words. I'm embarrassed to be sitting up here and be the recipient of all these very nice compliments. So thank you so much. And yeah, thank you. Thank you for, there's no better honor as an academic to have people care about your work, as you will find, or as you have already found. So it's just, and it's wonderful to have people like yourselves who are so accomplished and who have really guided me in this area saying these things. So yeah, I'm going to try to read my notes, and I will say that I am struggling with, there's a question of like, how much is this just kind of performative window dressing? And then real estate speculators go with their gut, their instincts, or there's some kind of, less visible, political relationships, deals that are taking place that, people like myself and also the quants are just not privy to. How much is even having a research desk at an investment bank, kind of performative? Like, see, we're smart. We've got this expertise. There's a great ethnography of Wall Street by a woman named Karen Ho, who kind of theorizes smartness. The importance of having PhDs and people with degrees in math and statistics from MIT and Berkeley working in your firm, and how ultimately within the firm, they're not really listened to that much. It's more important that like they get trotted out occasionally to say like, hey, look at our quants. We've got this knowledge, believe us. It's a kind of legitimacy move. So I struggle with that, and it's really hard to be able to sort of disentangle because even if it's performative, it can still be effective. Right? Even having this kind of expertise on staff and the kind of work that they do. So I guess unlike a lot of critical sociologists and sort of social scientists who kind of write it off as what Bourdieu called an illusio, I take it seriously. I take this kind of work seriously, even if I think there is a kind of performative angle to it, just because I think so much of, and this is not just real estate, it's so much like it's any kind of sort of speculative industry, and that can be in biotech, it can be in other, anything with the word tech is like, and then there's a lot more research in those fields. I think I'm just kind of doing it in real estate and sort of planning in the sort of built environment, but there's some great work there. How does it map onto the nitty gritty of construction? I mean, a lot of like particularly smaller construction firms or general contractors, they get directives to do this work, or they get contracts to do it. But the whether or not to release capital, I think the banks are a little bit more sensitive to this, and they can't build unless the banks are going to give them money. So I think it's less at that level, at the developer side, and more at the kind of controlling capital. I do believe that there is this kind of push and pull or tension between kind of the quote unquote rigors of calculation and all of these kinds of stomach metaphors, gut feeling and instinct, and all these things that are very physical, and I think there's also been too much made of the distinction between those things, right? And that we think calculation is so hyper rational, and yet we know, Flavia just gave the example of, like anybody who's done quantitative work, you can see, you're looking at these spreadsheet models and you just have a feeling that should actually be 3.5 instead of 3.25, right? So there's obviously a combination of these things, and it's hard to distinguish them. What's left for us, the citizens, or the users of the people who live in cities, are we all speculators now? There's a great book written by a guy Aris Komparazu Athanithio, and he's a long hyphenated Greek name, who is a professor in London, I think at UCL. And sort of that was, the idea is that like that the sort of speculative sensibility is not something that is restricted to property speculators or tech speculators or stock speculators, but that we are all speculators now. He even uses examples of like online dating, you know, and just sort of like throwing ourselves into the uncertainty of life through various kinds of platforms, sort of technology mediated speculations that are just, that sort of infuse different aspects of our life. I've decided to kind of cordon off the area that I'm looking at, you know, and by saying that I'm interested in kind of the industrial speculators, the corporations that are sort of incorporated for this purpose, as opposed to the we are all speculators idea. But I definitely think that kind of sensibility, you know, infuses our sort of present moment. And then can we despeculate the data? You know, like, can we rely on CoStar data and do kind of counter performative modeling or critical accounting work using the same data? Is it so sort of baked into the data? That's a really great question. I'm not sure. You know, can we, you know, I think that we have to just be sort of aware of the context and the sort of interests of the people putting together this information, and sort of to be, as we always say, critical consumers of the data that we rely on. So I hope I answered those questions. And then, yes, the like kind of wrestling with the different sort of intellectual genealogies that I feel I'm the result of, or that I've sort of, that I've inherited. And maybe this book is really trying, you know, to, as I said in the beginning, kind of reconcile a more sociological or constructivist approach that you'd find in like science and technology studies with like models formatting markets, right? As opposed to representing reality. So that perspective with this kind of more structural approach. And yeah, as you were saying that, I was like, maybe I should veer away from this means of production, means of prediction, because it's sort of signaling maybe an allegiance to a form of, I don't know, a kind of reductionist kind of a Marxist approach, of which I've definitely learned a lot from, but I don't necessarily think this book or this analysis is informed by, because I do think that, you know, there's agency, people matter, these models matter, and yeah, trying to find that kind of, you know, a way to bring together a focus on knowledge practices, which can say a lot and do a lot and tweak things and move things in different ways, with a sense of the kind of power relations that we see in, you know, property capitalism. I do think, yeah, there's conflicts that happen. It's not sort of a done deal that, you know, the house always wins, you know, or that property capital, you know, or whoever has the most power, or whoever's the biggest, or whoever has the most assets under management, like they're just going to win. For example, I'm thinking of Zillow's foray into homeownership. They got into the property flipping world. They figured, hey, we have all this knowledge, right? This is like information leading them into speculation instead of sort of the other way around. So for a brief moment, they got Zillow's like, we know what's going on with like every house or, you know, apartment in this country. Why shouldn't we just buy them? You know, like, let's just buy them and then rent them out. They tried to be, you know, owners of kind of collections of single family rentals and that kind of thing. And it didn't work out. And the CEO, when they sort of said, we're getting out of this industry, they were like, it's really too hard to predict future housing prices. You know, they're like, and basically they ended up making some really bad bets. You know, they bet big in some of the Southwestern markets. I don't exactly know, you know, what was behind that, but, you know, it doesn't always work out. And just like with some of the predictions and don't, you know, end up being, you know, fulfilled, and the speculative bets don't always end up working. So I'm trying to see sort of like what kinds of supports and prosthetics maybe predict which ones do and which ones don't, right? So not all forecasts are equally performative, right? Just because I say, you know, tomorrow it's going to rain. Doesn't mean it's going to. So yeah, what are the kinds of, what needs to be aligned for these kinds of predictions made to be, be realized or to materialize? And then yes, I do a little bit of in the book, a little bit of historical background to see like, when did economic forecasting become a thing? And it really was, like kind of the development of managerial capitalism and the sort of, trying to control commodity prices after the Great Depression, 1929, that you see the sort of the modeling and the kind of legitimacy of economic forecasting more generally really taking off. It's been harder to find historical evidence about when this is, became a big deal in the property world, but it does seem like there was some key moments in the 1960s with, like cybernetics and like, Rand and, trying to apply different kinds of models to urban problems. And then also in the 1980s with big speculative bets and big mergers and acquisitions and some of the, Wall Street investment firms adding real estate desks and also adding sort of research, mainly to do some of the kind of the prototypes for what eventually became like commercial mortgage-backed securities. So there is very much of a direct link between sort of, trying to acquire the sort of knowledge or bringing analytics in as the financial instruments and devices are becoming increasingly sophisticated and complex. So I definitely think that these predictive knowledge practices and the property sort of speculation industry sort of co-evolved, and sort of related to each other. How ULI fits into this, I'm not really sure. To tell you the truth, I really don't know about their early history. I know about like, real estate boards and, the kind of the role, like there was always an attempt to try to coordinate real estate activity because property development and investment is so interdependent. Again, you can't do it on your own. Like the price of your building that you own is so much, so dependent on your next door neighbor and what they're doing, what they're building, right? And if you're poaching tenants from each other, and there's all this sort of ways in which a kind of uncoordinated market ends up hurting individual investors. Like you add too much supply and everybody's prices go down, or, like, so I think these intermediaries, just like the early real estate boards, are things that became like BOMA, the Building Owners and Managers Association. They're sort of the advocacy organization for owners of downtown office buildings. They played a really critical coordinative role in the past. I think it's become a little less so over time. But they also, because of this way of reaching all their members, they play a really important role in that kind of attention economy and that kind of informational activism. So, right, that took a little longer than I thought, but thank you again for your great questions.
Hi, my name is Lily Irani. I'm a visiting professor in the information school, but also wrote a lot about future. So I really enjoyed your talk. I have a small comment, and then I have a very practical kind of organizing question. So the small comment is, I kind of like the means of prediction and the exchange you all had about it actually made me think about how authority or legitimacy for certain predictions gets generated through social processes, socio-institutional processes. And I don't know if that's something you talk about in your book, but if it is, then that might be a reason to hold on to that. The organizing question is actually, I teach at UC San Diego, and our city council is considering an ordinance to make it illegal in some way to use algorithmic price fixing. But part of me is like, is that like hitting the problem at the right level, or are these predictions working at other levels? Is this like political grandstanding by our city council, sometimes allies who want to be the progressive flank, but like, are they really doing it? So thank you. Any advice on that?
Wow. I'm amazed that, city government is getting in on this. In some ways, it seems to be the wrong scale. But, I would like to see what happens with this Department of Justice case again, and with RealPage, just like with their lawsuit against Google. And It depends if Lena Khan stays in the FTC position, the Federal Trade Commission, and like having folks like that who I think are, very, very concerned about this. I don't know. I'm. On one hand, I feel like it's become like the platforms and the have become a sort of easy enemy. It's easy to say, oh, it's their fault, just like parents blaming social media for their kids' dysfunction. I've done it personally. I'll admit that I'll do that sometimes too. But I don't know. The issue seems to be much greater than just the algorithm or the platform itself. And I mean, as we were, this is something that I've witnessed. Like, it's not like going back to the good old days of the real estate industry where you had brokers who were, racist and, engaged in redlining or, steering households to different parts of a municipality because of their skin color. Like, that's what we had when we had, pure sort of humanly mediated kinds of, decisions, as opposed to now going on Zillow and maybe not having a broker who sizes you up and makes judgments about where you would best belong, right? So there are some advantages to kind of depersonalizing some of these types of decisions that are now mediated through algorithms. It's just deciding sort of which ones or maybe make sense. And then we also need to understand, and this is where, Cy very kindly says, you understand real estate and development, and that took a really long time. There are like pretty high costs of entry to getting into that. And I'm happy I did it, but similarly, there's really, I feel like, and maybe those of you in the audience who really understand these technologies better than I do are in a better position to understand the degree to which the sort of bad behaviors are kind of, baked in. I think of like Ruha Benjamin's work on this and sort of the way that algorithms can also be racist and sexist. And, so like, what data, what kinds of assumptions are being built into some of these models? I think that's really critical. Thank you. Dan? Oh, sorry, somebody beat you to it.
Oh, sorry. Oh, so we've been staring at a photo of the moon landing for about 45 minutes.
Yeah, sorry.
So it kind of got me thinking about your intentionality in choosing this photo. And so I was wondering if you were like, is there like a statement you're making about like global land speculation and kind of maybe how like the United States is like winning that race through, like that's where the concentration of these firms are? Or I don't know, just there's a space race pun in there somewhere.
So. I think what I was looking for was more this kind of staking a claim in the future. I think like that's what these predictive analytics firms are doing. It's like, we own this, like we got this. And I felt that there was that same kind of sort of hubris that, involved in this kind of a sort of space landing, or space, the final frontier. I do think like the future it's a frontier, that is very attractive to, people with capital. And I think there's a lot of ways in which the future is being sort of anticipated and gamed and claimed, but only some claims are going to hold. And whose are those going to be? And will, like, so yeah, that's what I'm into when I talk about sort of the prosthetics that are needed to kind of make a defensible claim on the future. I guess this is just an image that kind of came to mind and I found it. So, and I forgot to write down where I, snagged this from on the internet, so don't tell anybody. But Dan, and then Aditi.
So thank you. I think this is really interesting stuff that you're presenting, and I really appreciate your coming out here. I have so many questions, but I'm going to ask one question. What do you think about the possibility that this new data sector represents a kind of more ubiquitous availability of what used to be specialized information held by people who knew local markets quite well and were best suited to providing information about the likely prospective appreciation of those properties? which gave them an advantage in actually being able to monetize that and profit from it. And that what's happening here is something that is just about more ubiquitous use of available information. That means that more people can have access to predictions. Whether they're right or not seems to be a really important point, though, because whether one succeeds in making a profit depends on whether one is right, and if one is right in a way that the rest of the market is wrong. And so it seems like, you know, the nature of the problem is that, as you've pointed out, the information that you're looking at is going to be largely the sort of information that is made public. But presumably there are people who think that their models are really the good ones, and they're not going to make them
They're going to keep the good stuff to themselves, like their
Right.
liquor cabinet. You know?
Yeah, and that's exactly, and that's the classic neoclassical economists' explanation for how this would work. And you're proposing something else, which is also present in this literature, about various forms of oligopolistic practice and coordination and benefits that people and market investors might receive from that coordination. And that's a really important tension, because one of them is about achieving gains that are about beating the rest of the crowd, and the other one is very much opposed to that. And it seems like it's something that's difficult and important to reconcile. And particularly, I wonder, with respect to that question, to the really important distinctions between property markets and other kinds of markets, like the market for produce or cars. And what's different about this market that lets and requires that enables landlords to collude implicitly through a algorithmic price. By the way, whether it's algorithmic price fixing or any kind of price fixing, it probably shouldn't happen, right? So that seems like the ordinance should be price fixing. But what is it about that enables that kind of price fixing to occur? And the answer might be something to do with planning. For example, I'm going to always come back, and anyone who knows me in this room will know I'll say it's all about housing supply. So, you know, if you have an undersupply of housing, then you can kind of get together and you can kind of set prices for it. So I just wonder what you think about that. I mean, in the commercial sector might be a little bit different, but the commercial sector, for those of you in the audience who don't know, the commercial sector in this context does refer to multifamily buildings as well as non-residential buildings.
Yeah, good. Several kind of questions embedded there. I would say that, you know, when Zillow got started, that was their argument, is they were trying to, they said, democratize this data, that otherwise there were these little, as you said, sort of little local monopolies and fiefdoms, and like brokers, you know, kept these like heavily guarded trade secrets about, say, you know, this is relevant to the work I've done on the office market, you know, how much of an office building, how many of those tenants were actually receiving concessions. So their effective rents were much lower than their listed rents. I mean, I think the same thing happens in the housing market too. So that kind of stuff is like not publicized, right? Those are those secrets that you keep to your chest, and like you only know it because you've got super, and traditionally, historically, the real estate industry has been very, yeah, kind of, proprietary and guarded about their information, and you know, then there's a lawsuit now against the realtors and sort of whether that, you know, so it's like there's been a lot of there's a lot of shakeup in this field because of that. So in some ways, so Zillow's trying to, they said, democratize their data. I would say that they're just kind of they're re-privatized. You know, it's theirs too. They make money off of this, so it's not truly a democracy. I mean, we can get on in the middle of the night, as I do, and see what people's home values are, or look for, you know, real estate. It's become a kind of national pastime. I mean, but they make their money because of the fact that we're all kind of addicted to this, or it's kind of fun and interesting. I mean, but I think we don't necessarily see sort of what's going on, the kind of the corporate structure behind the data and who's sort of benefiting from this. But I don't necessarily think that it's like liberating that data from these local monopolies is just kind of, yeah, recontextualizing and restructuring and giving owners of platforms an awful lot of pull, but not so much that they could control property values as the sort of failed experiment into ownership shows. So, and I do think there's this constant tension between, we have all these data sources. We've never been in such a data saturated environment when it comes to real estate and planning. Like there's just so much. I don't know about you guys. I get calls from people. Hey, we got a new data source. We have this. And and even Skyline, they're not necessarily creating their own data. They are like, what they're promising to do is just reconcile the gazillions of new real estate databases that are out there. But then, you'll talk to people who actually make the decisions, and they're like, this is what our analysts said, and we're going to take that as a data point, and then we're also going to take into account our gut feelings and our instincts and our experience. Like we've been in this industry for 30 years. So even though the data is saying, 5% cap rate or assume 3% rate of appreciation for this, we actually think it's closer to this. Right, so there's still this sort of playing games with the sort of public-private when it comes to data. So I don't think that'll ever disappear, and I think that's part of that's a justification for why there's still humans, right, in these industries. It's like we know things from our experience that this, that numbers that can't be spit out from this platform or from this algorithm. I think Aditi, you're maybe the last one. Yeah, okay. Yeah, turn around.
Hi, everyone. My name is Aditi, and so I have a completely different background in the energy sector, but we see virtually the same things in like many ways, especially with how power systems modeling is going. And my background is particularly in power systems modeling and predictive models and grid build-out models. And so I think the first question I have is a lot of these models that are used, they provide us with like these predictive scenarios, but they don't provide us just with one, they provide us with multiple. So what is the decision-making process in the housing sector on how these scenarios are actually used, and kind of what do some of those decisions look like? Because speaking, I guess, from experience, I mean, it's a little arbitrary, right? It like depends a lot on the goal and which scenario kind of fits that goal best, but also which one can help us make the most decisions in our particular interest under different types of uncertainty. So we're like super occupied with uncertainty in the energy sector. And then I guess my second question is, if these predictive models actually lead to more faith in the agents that are doing the prediction to do the build out of the sector as well. And I think it might be more concentrated perhaps in energy, because very often the people who are doing the prediction are also doing the build out. It might not be the same in real estate, but one thing in the energy sector that's happening, which I'm curious if it's happening in housing too, is this proliferation of open source models as a direct response to proprietary models. And open source models are this, like, people say that it is some form of democratization. I personally don't agree in every sense, but I'm wondering if you're seeing kind of the same thing. So yeah, a lot there, but thank you very much.
Sure. And there's some of that kind of the open source models, yes, there is a fair amount. I mean, I think too with AI but yeah, GitHub, there seems to be like a sense that it depends who you hire, like whether or not they have the capacity to do that kind of work. But I think that seems to be increasingly the case, that you might be able to circumvent the people who are selling these tools because you find their proprietary, model specifications now online, or you can reverse engineer the platform. You get somebody who understands this. This is where I feel like, yeah, I've got knowledge in real estate and finance, but I don't have like the computer science background. I think that would really help me in taking this apart. I do think that, as you said, models provide confidence, right? And I do observe a kind of like affect that is associated with in this world, and that's originally sort of even what got me into this topic. Doing research for my previous book, I was always struck by the hubris, of the folks I was talking to, developers or investors. Like, they would tell me things like, well, you know, the vacancy rate's going to go down to about 10% probably in 3 years. They wouldn't say probably, it will go down in 3 years. And that's when we will start building again. Or that's, you know, and so I was just struck by the preternatural kind of confidence. And I wasn't sure is this an act? Did they really think this? And then I began to explore, and you know, it did seem like there was this like a reliance on their quants and the model. So it's interesting because in some of the economics literature, the argument is that the forecasting models will actually suppress speculation because we'll have a better sense of what the future will bring, and there'll be less opportunity to extract speculative gains from the future. So the more we know about it, like knowledge will actually help to kind of tamp down on the possibility of speculation. I'm arguing just the opposite, partly this kind of more sociological argument that the models embolden you to take more risks, or the models point you in certain directions and then everybody follows the output and then you get a bubble, you know? So, but I think I don't think it's not easy to say one way or the other, it's this or it's that, but I definitely think there's a tension in terms of the relationship between forecasting or knowledge practices and sort of bubbles or sort of speculative behavior, which direction causation sort of moves. And then, yeah, you have lots of scenarios, and that's what a lot of these models are meant to do. That's what like the Monte Carlo simulations do. It's like, we're gonna give you 100 different possibilities for the future, but ultimately you have to act on one of those. So you can average them out. I mean, I see a lot of that, like, well, we know this and this and this, and we're just gonna kind of find that middle road that will, you know, but I do also believe that, you know, we have all these, we're looking at these different options, these different future trajectories, and then there's a leap of faith. You know, so we did all this calculation, we have all this knowledge, we have, you know, a sense of what all these different futures are, but ultimately they can't all be true, right? Or they can't all be acted on. You're gonna have to choose one. There are a lot of parallels to planning, not just, you know, urban planning, electrical planning, et cetera. So I'll end there. Thank you.
This was our last question. Thank you, Rachel. Thank you for coming.
Sure, thank you all.